Now, let's talk for just a minute about internal controls and cash. So let's start with the Sarbanes-Oxley Act. This is something that we hear a lot about in accounting. The Sarbanes-Oxley Act, also known as SOX, capital S-O-X. This refers to an act that was signed into law in July of 2002. It essentially came on the heels of some major accounting scandals. Some of you guys may remember names like Enron, WorldCom, Tyco. In late 2001, early 2002, there were a number of huge accounting debacles. Okay, investors lost tons of money. The companies went under. It was just, very, very sad and very unfortunate due to some unethical behavior in the company. In some cases, it was on part of management. On some cases, it was part of management and some of the auditors. So it was just some improper behavior. And essentially, the public lost a lot of confidence in the accounting profession and the reports that are provided by companies and verified by the accountants. So the Sarbanes-Oxley Act was legislation that was put in place to help protect investors. And one of the key elements, and there were many, many elements to this act, but one of the ones that's gotten the most substantial attention over the years, we commonly refer to it as Section 404. Section 404 put a requirement in place that management must perform an annual assessment of their internal controls. They have to provide this assessment with the financial statements. They have to provide it to the auditors, and the auditors must provide an opinion on management's assessment of internal controls. This was new. Now, a lot of people ask, was the concept of internal control new? No, the concept of internal control had been around forever, or at least a very, very long time. I think investors just generally expected that management was maintaining good internal controls, but it had never been transparently reported, and that was really what changed with SOX. It was a higher degree of transparency and a higher degree of accountability on the part of management. So, internal controls help to safeguard the company's assets and financial resources. It helps to ensure that we are processing information accurately, and it ensures compliance with laws and regulations. Okay, so those are really the goals and objectives of internal control. And one thing that I'll add here that wasn't mentioned in the graphic, but I think it's worth mentioning, another real objective of internal control is to make sure that the company has efficient business operations. We want to make sure that we are doing things as effectively and efficiently as possible from a business standpoint, because if we're not, we're putting the business at risk, and that is in turn putting investors at risk. So that's just something to think about as well. Now, let's talk about some basic elements of internal control. And sometimes you may hear this referred to as the COSO framework or the COSO cube. There are 5 elements, okay? The 5 elements are the control environment, risk assessment, control activities, information and communication, and monitoring. Okay, now you'll notice that we have the control environment at the top, and that is significant because essentially everything else is going to be affected by the control environment. The control environment refers to the overall company culture and the environment that management creates. Sometimes you'll also hear it called the tone at the top. Does management communicate that internal controls are important, that ethical standards are important, that it's important to have integrity, that it's important to be honest and to follow procedure? Is that what they communicate in the organization? Is that the example that they set? Do their policies and enforcements fall in line with that philosophy? So that's really the control environment. What is the culture and the environment that management has created? Is it healthy? Does it promote a workplace of integrity and ethical behavior? Okay, risk assessment. This refers to a company's evaluation of a variety of types of risk. Every company is going to have risk, all of them. Okay, so this is going to include consideration of things like, our operational risk, our financial risk, information risk, economic risk, maybe some environmental risk. Just what sort of risk is the company facing? Because we have to identify those risks in order to mitigate and hopefully, address those risks adequately that the company can continue to stay in business and hopefully thrive. Control activities. These tend to be the specific internal controls that we have in place over, say, a given process or a given account. Those are the control activities. Information and communication. This is how information is communicated and protected throughout the organization. And monitoring simply refers to management's review of everything else. Is management constantly reviewing the results of their risk assessment, their control activities, what's going on in information and communication? Are they continually reviewing it, assessing it objectively, and making changes and improvements where needed?